Hello, GovCons, and welcome back to the GovCon Funding Podcast, where we talk to business owners, GovCon business developers, finance teams, and even government contracting officers. Everybody wants to know, how does GovCon funding work, and what's the latest news to help me succeed in the government contracting business? Well, we're back with our co-host and co-founder, Matt Gilman. And we're going to talk about something that a lot of GovCons should probably know about. And these are some secret ratios that lenders all know about. They have them in the back of their mind every time they talk to you as a GovCon business owner. And these are the ratios they know within minutes whether or not you will likely qualify to receive funding from them. Well, we're going to get to those secrets in just a minute. But before we do that, we're going to talk about our disclaimers that we always talk about in our show. This podcast is for educational purposes only and does not constitute financial advice for your specific business or personal endeavors. Gilman Bagley and the people appearing on the show are not liable for your results from the content we present in this episode. If you want specific recommendations, contact us directly. See our contact information in the show notes or go to gbgovconfunding.com. And while you're there, you'll probably notice that we provide fast and flexible financing solutions to small businesses and lower middle market companies that allow them to access working capital by leveraging their business assets. And we've delivered more than $500 million to our customers with fast approvals and sometimes same-day funding. We did all of that with more than 100 years of private credit and business growth expertise. All right, Matt, welcome back to the show. Today, we're going to talk about these secret ratios that lenders know about and GovCons need to know. Even before you submit your documents, those due diligence documents that we talked about in the previous episode 6, these are the numbers that all lenders know about, and you as a GovCon business owner, business development, finance person, you need to know these as well, because they're going to tell you what your P-win is. And if you're a GovCon, everybody knows what P-win is. That's your probability of win on proposals. Well, guess what? You get a probability of win on funding as well. So, Matt, let's dive into these ratios that GovCon should know about. And the first one is debt service coverage ratio. Now, this ratio measures how much cash flow a business generates compared to its debt payment. We talked about this in previous episodes. This basically tells a lender, hey, can you afford to pay for this loan? It's like when you go get a house mortgage, okay? The lender, the bank that gives you that mortgage on your house, they want to make sure you have enough income coming in to service that debt, meaning you can pay for that loan, that mortgage. And if not, well, you know what happens if you can't pay for that mortgage. That's right. You go into foreclosure. So we don't want that to happen as lenders. That's everybody's nightmare. It's a nightmare for you, and it's more importantly, a nightmare for your lender. And we want to avoid that at all costs. So, Matt, can you walk people through what the math looks like on the debt service coverage ratio?
Yeah, absolutely. And these are numbers that I think everyone needs to understand and know, whether you're borrowing money or not, because ultimately this just shows, are you making money, right? And can you afford the things, that you want to be able to do? So, looking at your available cash flow to service debt, that's where the debt service coverage ratio comes into play. If you're making $1 and you have to make principal and interest payments of $1, then yes, you can afford your debt. Right. The question is there cushion? What happens if there's a negative event that causes, a period of decline in the business? Is there any cushion in there that says, hey, I can lose this one contract and still be able to afford my debt? So that's where you have to look at it and say, the higher the number, the higher the ratio, the better it is for you as the business owner. And of course, what makes a bank more comfortable, because you have the ability to actually service or repay that debt. So when you're looking at, going out and seeking financing, the first thing that you should do is sit there and say, okay, when I look at my financials, How much available cash flow is there, right? And do I have the financials that can actually tell me that? Because if you're doing cash basis returns, right, and cash basis financials, which we've gotten into in the past, that's just money coming in and money going out. But you don't know truly, are you making money unless you really understand your business and are doing accrual based financials, right? Accrual based financials are going to show you, are you truly making the money, right? And if you're truly making the money, how much debt you could afford.
Yeah. Okay. So walk us through the math. How do I calculate it? If I'm a GovCon business owner, I'm interested in getting lending, some sort of financing for my business. Maybe I want a new contract. I know I need to hire employees. I know I need to maybe buy some equipment as well. And it's going to be about a month, maybe 2 months before I finally get my payments processed into my accounts from the government. So what do I do? How do I figure this ratio out?
Yeah, this is super, super important because especially as companies get bigger, there's so much money that's flowing, right? Like it's so easy to say, okay, this payment's 2,000, this one's 3. It's the same thing as in your personal life, right? This is $1,000 a month. This is $1,500 a month. Problem is if you do it enough and you just see cash coming in without truly knowing if you're making money, right? That is something that can always cause, somewhat of a snowball effect where the debt payments are too high. And if you go look at, for example, an SBA 7A loan, because the debt service coverage ratio is, especially cash flow lenders are super, super, super focused on this number, right? Or this ratio, is they're going to look at the holistic picture, everything that exists, all of your payments, because especially in SBA 7A, you're often refinancing debt. So they're saying, if I take out, right, the existing debt and I look at what you're making, can you afford my payment? The problem that a lot of people come into is when it's the little things that they keep adding, where it might be an application only type equipment financing, right? Because you go and you buy a $40,000 piece of equipment, and then an 80, and then a 150, and then a 200, and then a 20. And what you realize is those lenders, the way that they are underwrite, aren't looking at your global picture, right? So like in many ways, the right underwriting group is really looking out to protect not just the bank, but also to protect you, right? So you can understand whether or not you could afford that payment. So when looking at these ratios and the actual numbers below, right, it's really simple. If you make $1 million of free cash flow, and that's after you pay yourself, right? Can you afford to pay your principal and interest payments on any debt that you have? So you can make $1 million, and we actually see this all the time. Companies are making money, but they can't afford their debt service, right? And that's something that people don't always look at and don't always understand is you could be making $500,000 a year, but you may have $1 million of equipment payments. And the thing is, the principal portion of those payments or loan payments, the principal portion of those payments is a balance sheet transaction. The interest portion is what hits your P&L. So if you're not generating enough money, you're sitting there and you're saying, yeah, but that money is going towards paying down an asset. Sure, you can say that, but if you don't make enough money, then you can't actually, there's no cash available to pay down that term.
Yeah. Yeah. And the math is pretty simple, right? It's that cash flow available for debt service divided by your annual debt payments. And so, yeah, pretty simple math. It makes sense that you need the cash flow to service the debt, meaning you can pay your loan payments, your financial product payments, whatever you want to call them. You can service that debt. Now, there's one other thing to think about, Matt, and that's different lenders have a different comfort level with this ratio. And, it's, again, we're talking about the debt service coverage ratio. Some people abbreviate it. They call it the DSCR, again, debt service coverage ratio. And, different lenders have a different risk profile. So typically your larger banks, they're going to be more conservative. Your smaller, maybe local banks, they might be a little less conservative. And so their idea of what a reasonable minimum DSCR can change depending on which type of lender you're talking to. And then for private credit, Matt, how would you compare them to, say, that sliding scale of large banks versus a small community bank? Is there that kind of a sliding scale with private credit as well?
Yeah, I think banks are always going to fall in the more conservative category, right? I think we all know that. When you move to private credit, I think you have to really look at products to understand, how much flexibility there's going to be in the debt service coverage ratio. For example, a transaction that has more collateral, maybe personal guarantees, maybe other things that are going to make a lender more comfortable. It's offsetting what might be a tighter debt service coverage ratio, right? So when you look at it, I go back to an SBA loan because I always think it's a really good example. An SBA loan has an SBA guarantee, and the guarantee is to help incentivize banks or non-bank SBA lenders to facilitate SBA loans. So, you often see a lower requirement on the debt service coverage ratio with an SBA loan. Plus, so the bank has a guarantee, then they have the collateral, right? So when you take collateral plus a guarantee, you can say, okay, I'm comfortable with this being tight because I feel like I have collateral coverage to be able to support this loan. And then when you move into other types of products, they might be interest only, right? So like an interest only or an asset-based line doesn't have the amortization on their line, right? So the focus is more on other ratios, collateral coverage, more than it's on a debt service coverage ratio. However, when you look at the entire picture, everyone's going to sit there and say whether they want to call it a debt service coverage ratio or not, or you, the business owner, wants to call it a debt service coverage ratio. Either way, you have to sit there and say, can the business or can I afford these payments?
And you may be sitting there thinking, oh, it's great. I have cash flow that can pay exactly the amount of debt payments that I will need to make. Not so fast. That's just a minimum. And for those that are looking at the slides, if you're just listening though, we have it listed here as a minimum DSCR of 1, meaning you have exactly the right amount of cash to pay the exact amount of debt payment. But that minimum, as Matt just said, that minimum can change from bank to bank. It can change from product to product. So, and what they consider an ideal DSCR, right? Because that's just the minimum. That's a very risky proposition.
Agreed.
Their ideal could be something different. So, for example, a general rule of thumb for an ideal DSCR is 1.25, meaning you have 25% more cash coming in than you would have going out to service the payments on your debt. And that's a good, healthy cushion, right? Because the lender then considers that okay, well, if you have a bad situation happen to your business, maybe you have a vendor that doesn't, a customer that doesn't pay you for whatever reason, then there's a little bit of cash cushion there, if you will, to be able to continue servicing that debt. So, but again, that 1.25, that may be ideal for Gilman Bagley GovCon funding, may not be ideal for your lender. So Matt, let me ask you before we move on to the next ratio, should a GovCon business owner, before they approach or as they approach their lender, should they just ask them up front, hey, you, the lender, what are you comfortable with? What's your ideal DSCR? What's your minimum?
Yeah, absolutely. But I even would go a step earlier and say, like, I always say that, us as a lender and the business owner are on the same team. We're looking for the same outcome, right? We're looking for a successful relationship. The business owner wants their company to survive, to succeed, and to be successful. As a business owner, the first thing that you should do is say, can I afford what I'm looking for? We call it stress testing, right? Like a 1x ratio doesn't give you any ability to have any type of negative situation occur in your business, right? One thing occurs and you can't afford a payment. And that's where you have to sit there as a business owner first and say, what can I truly afford? And what am I comfortable with? Some people might say, hey, at 1.25, I'm not comfortable because I have one contract that makes up 50% of my revenue. My option year, comes up in 3 months. If I don't win that and I go take on a long-term debt when I have this, short-term asset or renewal window coming up in an option year, if you lose that, you can't afford the debt. So I think a business owner has to sit there and always say, I know what I want. I know what I'm looking for, but let me make sure that I can align that to what I can actually afford, because that's what a lender is going to do. A good lender is going to sit there and say, I hear what you want. I hear the use of proceeds. I hear how this is going to benefit your company, but I also need to make sure you can afford it. And every business owner needs to do that first before approaching a lender.
Yeah, that's what a good lender would do. However, there are lenders, they really want your business, and they're not doing this out of any kind of nefarious intent. They honestly want your business. That banker is a business developer, and they want to win your business. And so they may be hesitant to tell you what their DSCR ratios, ideal and minimum, may be, because they want to give you a shot at potentially being onboarded as a customer. And they take you through 4 to 6 weeks of paperwork drills. And then at the end of that 6 weeks, they may tell you, oh yeah, you don't qualify. Well, so you can diffuse a lot of that work. And I'll tell you, I've seen a lot of GovCon business owners get upset at the end of that 6 weeks and say, well, wait a second, I thought you were going to give me this loan. And I just went through all this effort, time and effort to only be told no. Are you kidding me? And so it's a very emotional response. And I think it's important for GovCon business owners to kind of maybe shift their mindset a little bit. This is no different than you bidding on a contract, right? The government wants you to succeed. If they award it to you, they want you to succeed just as much as you want to succeed, okay? But you have to meet the requirements. We all know this as GovCon. Don't bid on something where you clearly don't have the requirement. You don't meet the requirement. It's no different. It's no different. And when you're told, hey, look, you can't have the loan, it's better to go into the discussion understanding where you fit. Do you meet the requirements of that lender right up front? Now, just because you meet their DSCR minimum or ideal, that still doesn't mean you're going to get a loan. There are other things that could pop up that are red flags that could concern them, and all those documents we talked about in episode 6. But at a minimum, I think this is just a gate requirement entry. Hey, where are you guys? And that will help inform your decision on, do you proceed with talking to this lender? Or maybe you proceed with talking to this lender, but you put other oars in the water. You talk to other lenders at the same time, shop around. Maybe go to your large bank. That's great. They're very, large banks, they have a tendency to be more reliable. They have a lot more products, but they also may be more conservative. So maybe you go to a small community bank at the same time. Maybe you put your oars in the water with private credit. That way you have a couple of backup options ready to go if your first choice lender won't come through for you. Okay, let's move on to the next slide, Matt. And this is the next ratio. It's called debt to EBITDA ratio. And we talked about EBITDA last week in the previous episode 6. We'll talk more about it here. We told you back then in episode 6, it's an important number. You should know your EBITDA all the time as a GovCon. It impacts so much of your business, not just in lending, but the value of your overall business as well. We'll get to that in future episodes. But so the debt to EBITDA ratio, Matt, can you tell folks a little bit about what it is and why it's important?
Sure. Yeah, I mean, this is also, the thing is, all of these are very simple ratios, right? They're very simple things that a business owner can do to understand, what underwriting is going to look like. And, I mentioned before, in the debt service coverage ratio, now we're talking about this ratio. I think we need to do a whole podcast on declining yourself, right? Approving or declining yourself. And I think there's a real way to do it so that business owners don't feel like they're constantly operating in an unknown or a black hole, when they're working with a bank or a non-bank lender. But with debt to EBITDA, right, really what you're looking at is another ratio that says, how much money is there available to repay a loan and over what period of time? So if you have EBITDA of $5 million and you have debt of $15 million, you have a ratio of 3, right? So it should take you 3 years, right, to repay debt of $15 million. And if you can do so, right, then it's another ratio that says the company can afford the debt, in the event that we have to term out a line of credit, for example. I think people have experienced where they may have a $5 million or $15 million line, bank's not comfortable anymore. The bank maybe changes what their appetite is, right? And they sit here and say, we're going to term this out over 3 years, and you could work on finding a new lender, or right, just make the payments over 3 years. The company can afford it, and we'll be out at that point in time.
Yeah, and these lender targets, we're showing it on the slides for folks that are just listening. Banks, they're typically in a range of 2.5 to 3.5 in the ratio. And again, to calculate the ratio, pretty simple. You just take your total debt divided by your EBITDA. Okay, so for a bank, that total debt to EBITDA ratio, that it kind of is in the sweet spot for them. It's 2.5 to 3.5. Okay, now for private credit, they may be willing to tolerate more risk. And so they may tolerate a higher ratio of maybe 4 to 6. Okay, so here again, you can see the sliding scale between different banks. Matt, does this also change for products as well? Before you mention about SBA loans versus other products when it comes to DSCR, does that kind of apply to this as well?
Well, so some products are really fixed, right? So like they're operating off of 7-year, 10-year programs or 25-year programs. So, there's not as much structure in the duration of the term, right? So you're often going to be living more by a debt service ratio than anything else. And I think EBITDA is always a, interesting number. I tend to work off of net income more than EBITDA, just because, you've got, unless you're fully replacing it, like in this scenario, right? Like we know depreciation is just a paper transaction, right? So you're going to add that back. You have to assume that the amortization is only right on the $15 million and there isn't anything else. You still got to pay taxes and you do have interest to pay, right? So like, I think there's a little bit more nuance when it comes to EBITDA. I think that business owners often talk EBITDA. And I'm just a big fan of like simplicity, right? You're making money. What's your net income? Add back depreciation. Because if you have debt, you got to pay interest. If you're making money, you got to pay taxes, right? So I'm just a big believer in, are you making money? How much are you making? And remember, amortization is not a P&L. Does not hit your P&L, right? It hits your balance sheet. It's a reduction of debt. So you could be making $5 million, repaying $5 million of debt, but that's taxable, right? It's the interest portion that's not. So, I always think the EBITDA, debt to EBITDA ratio is very important. But the bigger the company, you normally see more nuance in what's in all of those letters.
Yeah, great point. And so part of that discussion with your lender is possibly asking them what's more important to you as a lender. Is DSCR? Is it the debt to EBITDA ratio? Get that feeling, that understanding from your lender. First of all, which ratios are most important to them? What are the ideal numbers they're looking for? What are the minimum numbers they're looking for? Again, you're trying to understand what their requirements are so you can meet them or exceed them, just like when you bid on a contract, okay? And so this is this number 2, the EBITDA number, we talked about it a little bit about it in the previous episode, but cash flow, you should be able to know that each month, whether you're using QuickBooks or whatever accounting software you have, you should be able to know what that looks like. It's a pretty dynamic number. That's why some lenders like Gilman Bagley GovCon Funding, we like to look at that number because it's pretty real time. It's near real time, I should say. The EBITDA number is a little time late, depending where you are in your fiscal year, because that's typically a number that's calculated each year, right, Matt? So you're probably getting that from your accountant. When you're doing your books at the end of the year, this is a number you'll probably have available to you, but it's not something that's as real time as DSCR, right?
Sure.
Yeah. Okay, great. Well, let's move on to the final set of ratios here, and that's accounts receivable and accounts payable ratio. Again, we talked about this in the previous episode. Those documents we're looking for are your accounts receivables and your accounts payables. And we want to see the aging reports on those as well. So today we're talking about the ratios for AR, that's accounts receivable, and AP, accounts payable. Matt, can you tell us a little bit about why these are so important?
Yeah, and it's another simple ratio, and then we could also there's more. We're going to stop here today, and we'll talk about wrapping them all together and the importance of all of it. But this is a really simple ratio. Are you owed more money from your customers than you owe out to your vendors, right? Because oftentimes you might have net 30 terms with your customers, and if you have net 60 terms with your vendors, sometimes we see businesses take advantage of the fact that they have free money or free leverage or a free line of credit with their vendors because they're giving them extended terms. But if they're getting paid every 30 days or faster from their customers, we often look at and see, does that mean that they're not paying their payables, right, as fast as they're getting paid from their customers? And sometimes that drives the ratio in the other direction. So AR to AP is very simple. How much am I owed and how much do I owe other people? And if you're owed $1 million, or in this example, owed $5 million, and you owe out $2.5 million to your vendors, right? That's positive equity, right? You have $2.5 million of profit, right? That is sitting between your AR and your AP. And that's a super, super healthy ratio. The higher the AR and the lower the AP, the better. Some situations, we'll look at, and other lenders might look at, a 1-to-1 ratio, but you got to make sure the company's making money, right? And that's where, you go back to the global underwriting picture to say, okay, it's a 1-to-1 ratio. Fine, right? They're owed money and they owe out money. But if they're losing money, what do you think is going to happen? Their AP is going to grow, right? And it's going to grow faster than their AR is going to grow. If they're making money, you tend to see the AR grow faster than the AP is going to grow. So you have to add all these things together, but a very simple look as a business owner, sit there and say, what do I owe to my vendors and how much am I owed? And if you have a positive ratio there, then you're in good shape when a bank looks at you.
Yeah. And the ratios, again, for folks that are just listening and you're not looking at the slides in the video on YouTube or on our Substack, the ratio generally, again, these are just general guidelines, rules of thumb. Banks are looking for a ratio of about 2. Okay, so 2 times AR than you have for accounts payable. And for private credit, again, the tolerance may be a little bit better. Okay, they may be willing to do even a 1-to-1 ratio. Understanding these ratios is absolutely critical for you to succeed in GovCon funding, finding it, getting it, and using it. If you don't know these numbers, if you don't know these ratios, then your lender may have a certain perspective on you that may, you want to come across as a sophisticated GovCon leader. And we talked about these intangible things that a lender will look at. It goes way beyond the numbers. They're understanding whether or not you as a leader, your company are demonstrating bankable behavior. Knowing these ratios tells them that you're informed, you're sophisticated, you understand how the process works, and having a candid discussion with them up front, give them the numbers. Tell them just in a verbal discussion, here are my numbers. Let me walk you through the company story. This is what we did in AR. This is what we've got in AP. This is our DSCR. All right. And, these are our ratios. Now, this is our first discussion with you, the lender. Based on these ratios, how do you think we stand? Do they meet your ideal? Do they meet your minimums? And if they don't, all right, maybe we need to shop around. And that will save a lot of time.
I was going to say too, as a business owner, right? If you understand what a lender's looking for, right? And again, they're looking for understanding the health of your company. So they're very important to you as well. But if you sit there and say, okay, what are all the ratios and what are all the things a lender cares about? It doesn't always mean that everything has to be perfect, right? And I think that's the other piece here. You don't have to be a perfect business in order to qualify, but you have to have, I'd say 2 legs of the stool, right? Or like if there's 5 core things that a lender cares about, if one of them is weak and the other 4 are strong, you got a pretty good chance of getting approved. If 3 of them are strong and 2 of them are weak, your chances are going to go down. But if 2 of them are strong and 3 of them are weak, you have to sit there and say, I think I have a fundamental challenge in my business that I have to fix before I go out and look for financing. So I would just say, like, we can go into, I think we should go into this more and more and more. As a business owner, you really, really, really have to think about, can I afford what I'm looking for? Does it benefit me? And does this entire scenario make sense? Can I avoid time? Can I go to a lender basically with a package that is wrapped up in a bow, so it's easy for them to make a decision? When you do all of these things, it's only going to help yourself.
Yeah. And if you want to learn more and more and more, go back and listen to some of our previous episodes of the GovCon Funding Podcast. Stick with us, subscribe to this show, listen to future episodes as Matt and I go into more and more and more GovCon funding topics and news that's beneficial for you, helps you grow your business. And if you are in the market looking for a credit facility, you're looking for credit for your business, maybe your bank won't provide you a loan, maybe not. Maybe you ran through the ratios and you're thinking, okay, I probably need to shop around, and give us a call. We'd love to have a conversation with you, and just click on our website at gbgovconfunding.com and reach out to us there. Matt, I, and the rest of the team, we'd love to have a conversation with you. Matt, it's always been great having a conversation with you on the podcast, and we look forward to seeing everybody on the next one.